Hello and happy Friday, dividend growth stock investors. It is Colby, the DGI Crab, coming back to you with another end of week video where I'm going to go over each of the four tiers and we're going to try to find some value, some bargains amongst the group of 60 individual dividend growth stocks that the DGI Crab channel focuses on. It's not investment advice. I'm not a licensed professional. So do your own due diligence before you invest your hard-earned money in anything. I'm just sharing my strategy and my opinions on dividend growth stock investing and what I'm doing in this time of a absolutely on fire stock market. I just got done taking a look at it. I took a look at my VOO position for the S&P 500. The darn thing's up 20.5% year to date. January 1st, year to date, the thing is up more than 20%. Historically, the S&P 500 increases in value about 11% a year. That's going back decades over decades of the history of the S&P 500. 11% should be considered an average run-of-the-mill year. So that just means that if you do the math, you could erase more than half of the gains that we've had so far this year, and we'd still be having just a nice standard year. So the market's running way ahead. 56 of the 60 stocks in the DGI Crab channel portfolio are indeed stocks that are in the S&P 500. So what does it all mean? Now it just means bargain shopping is becoming even more difficult in these times. Now, at some point, we're going to come across a time where there's a market correction. We're going to have a bunch of different values on the four-tier spreadsheets to shop for. But for right now, we're going to be keeping it simple and zeroing in on some familiar names. So in case you are new to the strategy, the way that the allocation works for me is a minimum of 50% of the investment dollars for the week go into age-appropriate ETFs, only purchasing stocks yielding 30% or more above their 4-year average. That's the primary metric I'm looking for with these 60 individual stocks. Now, of those 60, my top 10 favorite stocks, they just need to be at 20% or more, and I'll go ahead and add those. I would say that you should remain in your tier unless there's a stock in a different tier that's yielding at least 50% or more above their 4-year average. And then as far as I'm concerned, doesn't matter what age you are. If you see a good deal, it's probably worth jumping on that good deal, and 50% off in most any context is a great deal. And if there's not any buyable stocks within your age tier, I don't think it's a good idea to reach down or reach up into different tiers trying to find a bargain. I usually just think, hey, it's a great time to add more to your ETF positions at that point in time. So, all right, let's jump into the tier. Tier 1, this is for the 18 to 30-year-old investors. And the goal with tier 1 is you're buying stocks that usually are yielding in the 1 to 1.5% range, but have a dividend yield increase history or expectation at least of dividends increasing by a good solid 12% or more a year. These are compounders. These are dividend snowball plays. The longer that you have to own these and let them compound, the more money you're going to have later on down the line. Nike is the only thing that we have here in that green section, in that green category of 30% or more undervalued. Nordson just slightly missed that 30% mark, but it's because the 4-year average yield for Nordson ticked up from 0.93 to 0.94 this week. So that actually was just enough to keep them out of that buy zone. I actually think that this is close enough that that it's perfectly fine to purchase Nordson at this exact price point here. I'd say anything under about $256 is probably fair game for Nordson to continue to be a good purchase price. Nike just announced this week that they have a new CEO coming in. I'm not an expert on CEOs or what that's going to necessarily mean for the company, but usually there's a lot of excitement around new CEOs. It certainly did a lot to help Starbucks stock a few weeks ago. So, we'll just have to wait and see how that plays out for Nike. But in the meantime, I still think that under $90, it's still a fine purchase. So if you didn't jump on the bandwagon when it was down in the 70s, still think you could do a lot worse than adding Nike in the 80s. So it's staying on top of the list in tier 1 for me. Moving on to tier 2 for the age 31 to 41-year-old investors, where we're looking to acquire a bit higher starting yield, usually in the 2 to 3% range, with an expected annual dividend growth increase of high single digits, we'll say, hopefully 8% at least, maybe even as high as 10. And man, we're down to just one in this category now as well. Hershey is still a fine value in my estimation. Anything under $200 share price on Hershey is a steal, if you ask me. Target has just fallen out of that buy zone. It's still pretty close, still not a terrible deal even here, but I'm a stickler on price, so I do want it to be right at 30% or higher if I can get it. And then, nothing else in here right now looks to be a great deal. And just so you're aware, again, if it's your first time here, I don't recommend selling anything once you've acquired it. You just let the dividends continue to reinvest and compound. And if you bought one of these, like if you were buying Caterpillar back when it was cheap, it looks really, really good right now. Let your runners run. Don't just jump out of that position now that you've gotten a lot of gain. It's just you're going to pause putting more money into it right now outside of dividend reinvestment and focus on the stuff that's cheap today. And Hershey is cheap today. Tier 3 for the 42 to 53-year-old investor, where our target starting yield is going to be above 3%, maybe even as high as 4%, and still expecting good, solid overall dividend increases year over year, but it's going to be closer to like the 5, 6, 7% range for most of these. Hormel and ADM continue to be the two in the green range, both excellent stocks, excellent companies. The 4-year average yield on Hormel just continues to gradually creep up by a basis point pretty much every single week. So the longer it stays down here in the low 30s, the less of an attractive deal it's ultimately going to look like. But for right now, 4-year average yield is 2.5%. Current day yield 3.56. So a full percentage point and some change higher than what it normally is. So looks like a pretty good deal to me in Archer Daniels Midland. They've just been down ever since I think it was February, I believe, that they had a CFO that got fired for just being shady, apparently being shady with the books, and their stock has dropped, and it just really hasn't fully recovered. It's just a stock that I think fair value is going to be more in the $70 range, and it hasn't been there for a while. So it's a great opportunity to continue adding ADM while it is down. Tier 4 for the 54 and older investors, we're looking for starting yield of at least 5% cumulatively, if not better. Growth rate, we're probably not going to get north of 5%, but if we can at least get in that 3 to 4% range cumulatively with this group, we're going to beat inflation on most quote-unquote normal years of inflation. Tier 4 has just been an absolute desert when it comes to bargains over the last couple of months here. I would think that the recent Fed rate cuts are going to be really good for REITs, like Realty Income, like NNN REIT, like Essex Property. None of these are trading at a massive discount right now, and usually lower interest rates are good for real estate development and real estate investment trusts. So these may continue to go up in price, even though they're not exactly trading cheap right now. Realty Income's the best deal among those three, but I don't know. I mean, it's not terribly on sale, just 8.8% above the 4-year average yield. I would think that the lower interest rates would be not so great for business development companies like Main Street Capital and Ares Capital. So we're going to keep a close eye on these and see if they suffer share price decreases here in the next month or two once the market's had time to adjust to the Fed rate cut. On its own tab, I do separate out my 10 favorite stocks. They're in bold if you were paying attention. I've got some of these here in bold on the other tiers. So it's not a new group of stocks. It's just these are the last 10 that I'll sell when the time comes, and they are if these were the only stocks I were allowed to buy, if I could have just picked 10, it'd be these. As I said at the beginning, if I can get these at 20% off, I'll jump in and get them. Right now, none of them are there. Pepsi's getting closer. So if we could get Pepsi to go down just a few more dollars here, I would be down to jump in and add some Pepsi, but not quite yet. Not at 171.18, unless we've got a pretty nice dividend increase coming or a share price drop. I'm just going to sit and wait on that one. So now let's talk strategy. What does the asset allocation look like for the tiers this week? Now keep in mind, this would be my allocation if I were in these tiers. I'm personally in tier 2, so you can know exactly what I did. If I were in tier 1, this is what I would do. So we're doing 50% into ETFs. So those tier 1 investors, I'd do 25% S&P 500, 15% into a small cap, 5% into a dividend appreciation ETF, and 5% into an international ETF. And then on the individual stocks, Nike was our only one that was absolutely in the green. So I would do 35% there into Nike. And we saw Nordson right there on the cusp. I'd still do a little 5% into Nordson. And because we're coming up on the end of September, which means all these ETFs are going to be paying out dividends to the shareholders, we're coming up on the ex-dividend date for those. Since I'm not seeing a ton of individual value still, I'd probably throw it that an extra 10% into VOO, making that a 35% allocation for the week. Tier 2, it's the same 4 ETFs for me. It's just the allocations are a little different, where the dividend appreciation is the highest one, and the S&P 500 is number 2. Small cap and international are still represented there. And here it's going to be 35% Hershey, the only one that's 30% or more undervalued in that group. I'm going to dip down into tier 1 and grab 5% of Nike, because that one is still 50% or more undervalued. So I've got no problem there. And since I only had the one stock in my own tier to choose from, I just did that extra 10% went into VIG. So that ended up being 35% this week. And I've got no problems with that. No problems with that at all. Tier 3. So tier 3, this is how I'm going to do it when the time comes. I'm going to go 15% each into VYM, SCHD, and DHS, and then continue to do 5% into the international. And for this week, I'm going to say 20% Hormel, 15% ADM, and then I'm just going to trickle 5% extra into each of these 3 ETFs. So we'd be doing 20% each instead of 15%. And then finally, for tier 4, I'm going to continue to do the ETF double down. So we've got high yielding stocks for SPYD as the main one here. Some alternative investments like high yield bonds, preferred shares, MLPs, 3 different covered call ETFs, and international. And this time around, I'm going to continue to do the double down on the ETFs, with the exception of my international. I'm going to keep that at 5% and then throw the extra 5% into SPYD. And that's going to leave me with 35% SPYD, and then 10%, 10, 10, 10, 10, 10, all the way down to VYMI, which is 5. Nothing wrong with going heavier into ETFs, you guys. If there's not a great bargain on the table with an individual stock, don't panic buy. Don't buy for the sake of buying or just because you want to buy. Just go harder into your ETFs in times like these. There will be market corrections and those can negatively impact ETFs as well, no doubt about it, but definitely less risky than individual stocks. We're waiting for a value. Links in the description below to videos on each of the 4 tiers. Go check those out, you guys, and I will talk to you.